Welcome to Get Serious. Today, I wanted to share some insights from the JP Morgan private bank outlook for 2026. You can see a lot of, this is typical for a lot of content production toward the end of the year. It's like, okay, reflections on the previous year, outlook for the coming year. I like it. It works. End of year is a perfect time for reflection here. And I think this report is very, very well done. I've never read JPM's annual report prior to this year, but it was linked over to me more recently. So it's about 60-ish pages of PDF, a lot of diagrams and so forth. I would highly encourage you to. It's for free. Download it at your convenience here. Skim it at a minimum, I'd suggest. But I read the full thing. Just found it very, very valuable. And like the overarching takeaway is, a lot of the banks and so forth, like when you read their outlooks takeaways, like they just, they tend to be more conservative, right? Like we had the GFC crisis where, the bankers were just being, far too liberal with their underwriting and, cash allocations. But like banks have just changed, pretty significantly. And just, underwriting tends to be more secure and it's backed by more underlying liquidity and assets ratio. And I think it's like federally required to be doing all of this anyway. I forget from which piece of regulation, but I found this to be like just a very, very well-researched report. It should be. JP Morgan is one of the 10 largest companies in the world, and specifically the private bank division, manages their high net worth clients. I think there's some exceptions, but generally you need at least $10 million in liquid assets within Chase's core asset management systems. Like pretty significant. Not many folks in the world can qualify for that. So they tend to have their highest level analysts and operators within their private bank division, just to kind of set the scene here. And so their overall takeaways, and it was more bullish than I would have expected here. And honestly, their arguments have made, I'm from a real estate perspective, I would still be more bearish in terms of, I think the job market and just, the overall amount of folks who can afford land and so forth are still just low. It's still going to be more of a buyer's market across, I think, much of the country. But I'm, from this pure macro perspective and thinking about, possible AI bubble, all of that type of stuff, I'm more headed in the direction towards at least kind of a more balanced viewpoint to potentially bullish here. Like I'm very, very bullish on just the opportunity of AI itself. But whether we're going to have some short-term hits or how quickly it's going to hit the job market, I think it's really hard to predict. But we'll kind of see which future kind of comes to pass here. So Chase overall is like, there's definitely some warning signs within the AI bubble, but they don't see it about to burst here. So I'm going to just point out a handful of things, and it's a longer report you can read for yourself. But a key point that they mention is, and you really have to look at this from your own business as well too, is just, almost half, 45% of businesses as of 3 months ago, September 2025, so probably even more now, already have active LLM subscriptions. Over 300,000 enterprises are customers of Anthropic who have pretty much shifted purely to a B2B type of setup, kind of letting Gemini and ChatGPT take over the B2C space. Like, who's going to stop paying for these? Like, their revenue generation and the prices keep going up for the most part for these models here. Like, what businesses are just going to stop paying for these and stop fueling or funneling revenue into these AI companies? So we saw in the .com, so the .com bubble companies, they weren't generating revenue, a ton of them. They just had really inflated valuations, but like a lot of these AI companies, yeah, they might have crazy capex and all that. Um, but they have so many customers and it's growing. Like again, look at your own business here too. Look at ours, where like if I'm looking at my tech stack here, as hairy as things could potentially get, like if I was just having to like, look at my entire stack of overhead and you were to rank, every single software and technology that's, part of your company here, which ones would you just start checking off, as far as like, oh, if we had to make cuts here, like if you could only save, I don't know, 3 to 5 pieces of your tech stack, like what would you save? Like an LLM would have to be one of them, right? Like I suppose you could try to use one of the free versions. You're just going to get capped so quickly on utility there. Like to me, I would fight tooth and nail, like basically down, like saving an LLM subscription, like might be my number one choice to maintain. I'd really have to think about it there, but again, like it's a thought exercise. Like how much do you value these things? And I think a lot of businesses are in the um, same situation. Like no matter how bad the economy gets, like you can't throw out your LLM subscription. Like it's just too valuable. Um, and uh, so yeah, I mean they go in, okay, can we see what could be a potential boom versus a bust here? They mentioned the various paradigm shifts, and I've seen a number of folks make these arguments. I'm sure you've heard of them too. The railways in the late 1800s and the telecom infrastructure in the late 1990s. Abundance of the availability of credit and increasing leverage, decreasing underwriting standards, valuations versus cash flows, feedback loop driven by speculation and versus broad participation here. But ultimately, like they kind of steel man the arguments that the AI bubble, even assuming we are in one, which I think most people would agree with it, but is it really going to go bust? They're pointing out that the factors weighing against a potential bust are just, more stacked in the favor of kind of like a stable operating environment compared to some of those previous bubbles that burst in the past here. In particular, yeah, there are some operators and companies that are at higher risk with their debt obligations and ability to generate revenue, but like the key thing is like some of the best, if not the best companies ever created in the history of the earth that are so capital efficient and generate so much cash flow. The Microsofts, the Amazon, Alphabet, Apple as well, Meta, like they just generate tons and tons of cash that they're still able to position themselves well even during this hyperscaling period here. So, Chase like makes um, a big argument. Like the biggest risk is just not having exposure to AI, at least as part of your portfolio, or just utilizing it within your own business. Uh, but they're making note. Yeah, there's old jobs lost, new jobs are born here. And they are noting, I know there's been like discrepancies across various reports here of like, yeah, is AI really adding productivity and so forth? They're citing some examples. Yeah, the early returns on higher productivity are encouraging here, but you have to still have kind of like tepid expectations. Like it takes a while for humans to fully embrace technology. I talked about that on more recent podcasts as well too. And they're just mentioning, yeah, I mean, even if a bunch of jobs might get cut out here, like they do mention, there's compared to 1940, there's a study by MIT where more than 60% of today's jobs did not exist, yeah, roughly 85 years ago. So like this is just the way that the world works. And even if AI can continue to take more job opportunity specifically from task sets that people are performing, they're like, yeah, humans will just have enduring advantages. Common sense, causal reasoning, emotional intelligence, high stakes judgment, adaptive learning, intrinsic motivation, especially the latter one. That last one, intrinsic motivation. I don't know if AI can ever be motivated for further growth here. Whereas some of the other ones, I think you could eventually teach it common sense and causal reasoning. Honestly, even emotional intelligence. High stakes judgment is tougher, but I think it can get there. Like this is the AGI promise, right? Like, AGI I think can do all this, but will it ever have motivation? That's an open question. So again, food for thought there. Still, so many people are AI passengers versus drivers, which I always mention. You still have a lot of room to use judgment with today's current LLM models. They do mention more about like the potential limits to AI expansion. There's the energy piece here. A lot of the infrastructure, like 70% of power lines across the US are over a quarter century old. China's been doing a lot better with building additional power generation. So, something to consider. I know folks are debating this actively. We add some nuclear generation and so forth. Resource scarcity, privacy, safety concerns, all that's going to shape, public sentiment. That might create or destroy a lot of financial value here. So TBD, that's probably the biggest piece here. And even on the water piece, like, how much, water are you utilizing for data centers? That's been largely debunked. There just isn't that much water necessary to run various AI queries, or far less than you might expect. But like the power generation piece is still a way bigger factor. And so and then private bank kind of goes into who's kind of winning the race here and what to kind of look out for as far as an investment strategy. They're like, stay focused on the hyperscalers, the large cap, the Microsofts, the Alphabets, like I mentioned. And they're actually, Amazon, Meta, I know I mentioned them earlier. They're like, they're actually a little bit more tepid about that based on free cash. Or Oracle has really taken a hit lately. So, still, the large cap leaders are going to be more positioned to continue to take advantage of this, find opportunity within that AI supply chain. The various semiconductors, NVIDIA, still probably has a chance, or other potential competitors here. Transformers, networking equipment, fiber and subsea scales, like all this can I was looking at this from like a land perspective too. Like there's still so much physical infrastructure, which tends to be the lowest possible alpha from an investment perspective. Like when you're jumping on the base stakes to create value, like you're just further down the value chain, but there's still so much opportunity there with how much actual real estate is needed just to fuel and provide what we need to take AI to the largest possible outcome here. So being able to extract resources with the rare earth metals, valuable land and water rights, like if you can work on that type of level, like you're still going to be able to hit the jackpot from physical infrastructure type perspective. And then who are those smart corporate users of AI? And very interestingly, and this is kind of like the rich get richer theme here, is that oftentimes you think of like those larger enterprises with thousands, tens of thousands of employees, like they're just kind of being slower to move. Oftentimes that is the case, but they have actually adopted AI quicker, and that they're able to more efficiently integrate AI into their existing work streams and business models here. So pretty darn interesting from that perspective. Usually, you think of like startups moving a bit quicker here, but it's really more of the entrenched corporations that are actually making bigger gains from that side. And similar to how I've mentioned on other podcasts and stuff too, like and private bank, JPM points this out too, is like SaaS companies probably are not capturing enough value from AI enhanced products. And half of the stocks within their broad software index fell over this past year. And even though it was like, still a net 17% gain because you had the AI companies within it, a lot of SaaS is going to be eating it hard over the coming months to years here. If you can get private exposure to AI companies, they recommend that. Various, like 60% of VC investment in AI over the past year, roughly. No surprise there, but what they really pinpoint is just how we have, like from a public opportunity side, where the value is accruing. Like we haven't seen anything from a platform technology or an application perspective. So like what I mentioned earlier, and so there's some public exposure to this too, is like for a phase one of any technological build out, you have the physical infrastructure here. So, that can be, your power, your data centers. And then there's the digital infrastructure, which also has a lot of public exposure. Like think about NVIDIA. So that can relate to the core hardware, like the semiconductors that are powering AI. So there's already been like 10 trillion plus in value created just from digital infrastructure. Physical, maybe like a trillion or so, like still really big numbers, right? But so far for a platform technology, which could just be like base LLMs or APIs that are utilizing AI, and then applications, which could be full AI enabled software, AI copilots, various agents that are built for custom solutions. Like those are just purely private enterprises at the moment here. Like there's no public availability for you to invest. Like it's just too early of a technology for these platform technologies and applications that the public's even gone. And we're going to see that change when Anthropic and OpenAI go public over the coming year here. So it allows the public to actually get in. But like, JPM thinks that, typically the most value is created the higher up the chain you go. The platform technologies and the actual applications create the most value. Again, look at the internet. The applications eventually created the highest value after the infrastructure plays. Something to really keep in mind going forward here. Again, they're kind of mentioning like within your portfolio, tech and tech-related sectors are, about half of the S&P total market cap. So just FYI, the U.S. has largely made a bet on AI, so it could go the other direction if things don't pan out in a more bullish sense. The other two pieces here, again, I know I really wanted to spend the most time on the AI side because I think it's most interesting to us as entrepreneurs. A couple other things here to mention. So the other part two is just like, there's a deglobalization going on. Peter Zion talks about this all the time. If you haven't checked out any of his works, I highly recommend it. He's probably a bit more bearish especially from a tech perspective, but for just an overall understanding of geopolitical dynamics and demographics all across the world, like there's few folks better than him that have a grasp on that type of thing. And this is just more mainstream topic now. Private banks pointing this out. Like there's just a lot of reshoring of industrialization. Is it all going to go to the US? It's unclear. That's the goal, but is it actually heading in that direction at the moment? Not really. Tariffs are kind of having the opposite impact of that. But can we bring more into the Western Hemisphere just to make it easier? And even with all these tariffs, there's still lower net tariffs on Canada and Mexico. So, the heat of kind of the arguments between those compared to the earlier part of the year has diminished. And so those are really the partners that we should continue to invest into. Our reliance on China has gone down as well too. Like this is just going to be a continued trend. This is just worth a whole other discussion here. But again, this is just kind of investment thesis across the entire world that Private Bank is mentioning. They're like, deglobalization, keep in mind, probably a lot more reshoring, might be higher costs to build infrastructures within the US or the Western Hemisphere, but it's more secure. The supply chains are more reliable, especially for semiconductors. It might not even be possible to build those out. In Peter Zion's words, for potentially, multiple decades. If a piece of the semiconductor global supply chain busts down right now, we'll see, I guess, in probably a matter of years here. They're mentioning kind of energy pieces where, United States, China have kind of clear advantage of cost of electricity. China, I'm surprised they mentioned more bullish there because they have to import all of their oil. So, I know they're kind of relying on some hydropower and a lot of coal still, very dirty electricity. So, we'll kind of see. But in order to fuel like just cars or industrialization, like they have to import their oil from the Middle East, which is not an easy trip. Mentioning kind of stores of value, dollars, etc. And then part three is just like, again, deeper focus on the reasons why, but just like expect inflation to be more steady probably, or even like a little bit higher just going forward at the moment while we deal with just the growing debt within the US and potentially can continue to like lower interest rates a lot more, and that can lead to greater inflation. The tariffs are also impacting inflation as well too. AI investment and having to reshore various supply chains to the Western Hemisphere or the U.S. All of that is inflationary, so just have to be aware of how that might relate to your approach for various investments here. And they talk about various fixed income sectors, what to orient around. Most specific to us as real estate investors is they do mention that there's still a net U.S. housing shortage. They're mentioning U.S. is still underbuilt by like 3 to 4 million units. Could take another 10 years to close that gap. But again, like they also mentioned, the prices are just about as high as it's ever been in terms of affordability, and the fact that the monthly cost to buy a home from a mortgage perspective is 50% higher than the cost of renting a home. Key to keep that in mind, and so like they're just more bullish on the rental market, or rental rates just continue to be stronger, or just building BTR, build to rent type homes are going to be a stronger play over this coming time, especially as over 6 million people, a lot more millennials will enter into that 35 to 49 year age group, a lot more family building. It's just historically been the prime age for home buying here. You have two kind of competing forces here, like really high unaffordability, demand for homes. Where do you kind of meet there? Probably within the BTR space. But to do BTR well, like you still need land. So there's a lot of room for us to consider this as far as how we look at real estate investment. And they do mention this, like okay, what are some asset groups that can help fight against inflation a bit? Look at commodities, oil, in particular natural gas, which is a critical input for AI data center build out. You could look at that. And then they do mention, real assets, infrastructure and real estate. I hadn't really heard, investing into global infrastructure here, but, it tends to deliver 8 to 12% returns here. Inflation resistant cash flow is pretty interesting. And again, you're just going to need more demand for power and improving some of that aging infrastructure that I mentioned previously. So even some of like the most savvy investment groups in the world, like they're mentioning 80% of family offices that they surveyed, so they don't have any exposure to global infrastructure at large. So it's an underappreciated asset class and something that we could take advantage of as real estate investors with some creative thinking. And then they were just mentioning, just global real estate. We tend to only really think of U.S. real estate, feel a lot more comfortable there. We have a lot more insight into the data, more consumer protections and so forth. But can be a solid inflation hedge. We think about that, just via land, especially. I know a lot of folks will think about that from an investment perspective here. And they were mentioning that, commercial real estate returns, they actually fell almost 20%, but they had 8% of net operating income growth, which is pretty crazy. So yeah, not really. I would need to think about that stat a little bit more to actually I would probably go to ChatGPT and ask a bit more about that. But kind of interesting from just how nasty commercial real estate has been over the past few years here. But they're really bullish on rentals and industrial. We've seen that industrial has tended to have a lot more appreciation whenever we find land in the industrial zone or has a potential zone for industrial. Like it tends to be pretty inflated. So key to note from that perspective. Also, just outside the U.S., they were really mentioning that Europe as a whole has probably a 20 to 40. It's roughly 20 to 40% undervalued in relation to, just what the underlying real estate would be expected to be valued at, I guess, based on income. That's generally how land is deemed, over or undervalued, or just real estate writ large. Pretty interesting there. Again, I wouldn't be just jumping to get outside the US until like we were just exhausted almost every opportunity here, which like we're not even remotely close, and we could work here for the rest of our career and still be scratching the surface. But when you see numbers like that, 20 to 40% undervalued, like the US writ large is largely overvalued at the moment. Like the real estate market got too hot. Europe, you'd have to open up a whole bunch of can of worms. The demographics are not nearly as strong, so your buyer pool is going to be way worse compared to maybe like expats buying it, or just various investors looking just for exposure. More speculative, but kind of interesting to note here. So that's what they're thinking of, and then they also mentioned that like hedge funds can be a good place to place money. That doing 10% of your exposure into hedge funds or alternative investments, which we could consider land. I mean, that's like the alternative of alternatives, right? It's such a risky asset class that few decide to put a lot of money into it. Portfolios with that type of alternative exposure have performed much better over the past 10 years here. So interesting to note if you're looking for capital partners with more liquidity to potentially participate in your alternative class. That's where we're at there. Again, a bit longer here, but this was 60-page report. I was trying to zoom through the key takeaways. So hopefully this helps you for your 2026 outlook. This is fun for me to report on again as well. SeriousLand.capital for any of your land funding needs, and subscribe and share. Looking forward to next time. Take care now. Bye.